It's not enough that you love to invest in stocks. 50% of your job is done by picking the right stocks, but the rest 50% is about building a portfolio of stocks. And that is the key to building a successful long term portfolio. So, today we are going to discuss about how to build a stock portfolio that is resilient to falls and also helps you build wealth. So let's just take a step back. When you decide to invest in equities, in stocks, it's important that you decide whether you're going to do this for the long term or the short term, right? Most traders, those who use technical analysis, for instance, don't look very long term. They look at very short term analysis, and therefore their objective is to make money through trading. Now, here I will largely focus on what it takes to building a stock portfolio using fundamental analysis. But many of these points will also be applicable even if you're a short to medium term trader. First, once you decide that you want a fundamental analysis or technical analysis, please understand what it takes in each of these. For example, even in fundamental analysis, although you might do your groundwork and identify a stock that is mispriced or temporarily missed buys and can compound over the long term, you might still want to use a price point to enter, right? So that's where technical analysis comes into play. So even if you are a fundamental investor, you can use technical analysis, or you can set your own price in terms of valuation of the company also, and track and pick the stock when it reaches the price. So at Prime Investor, for example, for picking our stocks called prime stocks, we follow a fundamental approach to picking stocks. And but we are very conscious of identifying a good price point. We put stocks that we identify in our watch list and look for price points at which we can enter or accumulate. Now, this is key to investing in stocks. Please remember, many of you have asked this question, and I have, spoken about this in earlier, videos about investing through SIPs in stocks. This is not mutual fund. Price point is vital to entering stocks. So please keep that in mind when you build a portfolio. The first thing about picking a stock is understanding whether you want to do technical or fundamental analysis. And even if you want to do for the long term using fundamentals, looking at the price point becomes key. The next thing when it comes to building a portfolio is about what style do you want to follow. Most investors like to call themselves, I like to follow Warren Buffett. I use a value style of investing and so on. But in our view, for all beginners and to also somewhat, seasoned investors, it is good to have a mix of growth, both growth and value style of investing. This is because not at all times will both these styles perform. So there will be times in the market, say after a big bear correction, you might pick stocks that are really underpriced, and that's naturally, value kicks in. But there might be times, peak of the market, when a big rally has happened, a very good stock may be at a very high premium, and you might run the risk of entering it at a price point that is very uncomfortable, that may not provide upside. So it is very important to mix your growth and value style. Look for stocks that are underpriced, that may not have immediate stock movement, but will give you deliver in the long term. And also look for stocks with high earnings growth. When you're willing to pay valuation, you pay for high earnings growth. So try to mix both of these in your portfolio. The next question is the question that is often asked, how do I diversify my portfolio? How many sectors should I hold? The style that we already spoke about, and then the market cap. Should I hold more large cap, mid caps, or small caps? Now, these questions are not very easy to answer, but there are ways to approach it, and you can simplify it in this manner. Look at the indices themselves. If you take the Indian indices, for example, the financial sector occupies as much as 40% of the index. But Now that's a high risk. You might as well take an index fund or an ETF to do that. If you're building your own portfolio, it is better to restrict weights, in our opinion, to about 20 to 25%, even in the highest weighted, sector in the bellwether index. And pay attention to owning sectors with different growth drivers. For example, if you're going to play the banking stock, on the India's economic cycle, then playing the infrastructure, or say playing the commodity players, all of these amounts to playing growth, right? So your style is not going to vary. Then you're going to play the same theme right through, and they all fall together. So if you want true sector diversification, you need to strike a balance. You need to strike a balance with more resilient sectors. That's what we call as being cyclical and defensive. For example, the banking or infra that we spoke of as cyclical, whereas the defensive might be FMCG and IT, where the earnings volatility is less compared with the cyclical ones. So by mixing these two styles, you get some diversification. Similarly, once you decide the style, naturally the sectors will fall in place. So the other way of looking at it is market cap. If you want a lower volatile portfolio, naturally you need to have more large caps. You might also want to look at the stocks history to understand whether a stock is very volatile. So if you are entering a very volatile stock, then you need to kind of diversify it with more stable stocks that may not move up very fast. Their standard deviation, for example, in that stock might be quite low, but they have been steady compounders. So historical data is also helpful, or just looking at market cap based style and investing. If you're very aggressive, for example, having mid caps and small cap is fine, perfectly okay. There is also another way of approaching without looking at market cap, which is just being fund managers, speak of being market cap agnostic. That means I will just pick a good stock and I will invest. But please do keep in mind about the sector cap, right? You can't go overboard just because, the infrastructure sector is doing well. If you go overboard on it, there's a very high chance that your portfolio will get hit before you can even make adjustments, right? So that's something that you need to keep in mind. But the important thing here is when you start out investing in stocks, you can't achieve this diversification. Please don't worry about it. Many of you ask us, shall I invest in all of these stocks at once? No. So, for example, at Prime Stocks, we give a list of recommended stocks. And they were given at multiple points in time. Please remember, you can't invest at all of them at once and hope to achieve diversification as well as having entered at right price point. Put them in your watch list. Look for price points or market corrections where you can buy. So initially, for example, you would have just bought one bank and one IT, so you'll have two sectors. There's no sector diversification. It does not matter. Sector diversification, style diversification, and market cap diversification is achieved with time. As you build a portfolio, as the number of stocks in your portfolio increase, that is the only way for you to build a diversification. So when you start out, it is good. If you want to reduce the risk, it's good to start with large caps. That's the only reason why people say just don't go, because when you start out, you don't have the advantage of diversification. And if you take a very high risk bet like a small cap with low liquidity, then the risk is that much more compounded. So keep this in mind, and you will not achieve diversification as you start out a portfolio. It does not matter, but as you add stocks, be conscious of the fact that you may be increasing in the same sector or same style of investing. So when it comes to the next point that I made is about stock weight, right? So when you start out, obviously one stock, two stock, the weight of the stock will be very, very high. But you know, diversification can actually sometimes be quite counter, intuitive when it comes to stocks, because the biggest risk in stock investing is about investing too little in really good stock picks and betting your house on that stocks, right? So this is important. So when you try and invest in a stock, you have to build positions in the stock. This is typically what traders do. Traders give importance to position size, and they also have risk mitigation. For example, if a trader takes 10 lakh of investment and says he will restrict his loss to 1%, so he says this x amount, 10,000, is what I'm willing to lose, right? That is one way of looking at it. But in order to restrict it, he or she will build an optimal portfolio to achieve that, right? That's exactly what you need to do when it comes to your stocks. So you can decide on the weights of your stocks, like I said earlier, based on the stocks historical risk reward characteristics, whether it's been very volatile, it's been a high performer with periods of flat performance. That's one way. The other more qualitative approach is to kind of increasing exposures to stocks that you have conviction upon and where you have higher understanding of the business. So that way you can be more sure you're betting on stocks that you know well, which is good. So and or if stocks have reasonable valuation, then increasing exposure to it would make sense rather than putting on more money in a stock which is already at high valuation, right? So that's another important factor. But if you want a number, a quantum in terms, in general, again, there are no thumb rules. Anywhere between 12 to 30 stocks in a portfolio provide adequate diversification. This, if you have, several lakhs, okay, you cannot be achieving diversification with, say, 10,000 or 20,000 or 30,000. But when you have a sizable corpus, which means you will have about 3 to 8% weight in each stock, right? This may rally. Please remember, you start out, this weight as a stock outperforms may go to 10%, 15%. And when the stock valuation also kind of moves too much, you could consider booking profit. But that's a separate topic that we'll talk another day. But this is how you build, kind of size. If you start with 1%, please slowly try and add to stocks where you have high conviction on. And you can also set a band for your individual stock weights based on the downside that you can take. For example, a 10% in a weight means that a 50% decline in price can hurt your portfolio by, say, 5%, right? So is this how much I can take? If you can take an overall 15% fall in your portfolio only, and this stock itself can fall by 5%, then you need to be careful about the other stock weights that you're taking. You can't have similar high volatile or high risk stocks in your portfolio. So you can do this in terms of just setting a quantum, a number, or you can look at your downside. Like I said, this is what traders do, right? You can look at your downsides and then you can decide what is the weight that you can take to cap the downside. And when you're buying in bull markets, please remember this. It's okay, it's easier to buy in market falls, although most people will be driven by fear, but that's when it's easy to buy stocks. But in bull markets, it's best to start out with small amounts and then add your positions, especially when markets fall. At Prime Investor, for example, we keep saying, buy on dips. People ask us, should I buy the stock on sips? We say, no, no sips, buy on dips, right? It is important. Timing is important, and you have no choice. If you are taking a high risk bet, you have to build positions slowly. This need not be the case with very large cap stocks, very kind of stocks that are steady earnings compounders. For example, in the last 10 years, stocks like Infosys, HDFC or HDFC Bank, it doesn't matter. It's price points that you entered. Even if you had entered a high price point, they would have delivered decently because the downside is somewhat contained. That's not the case with mid and small cap. The last thing that you need to understand is, however appealing a stock might be, don't go overboard on it because the whole market is going, and that's where the concentration comes in. That's why it's good to set this limit of weight per stock for you so that you don't go overboard on that stock. And finally, have a cash component. This is a very, very, very important part of investing, whether you're a technical analyst investor, short term trader, or fundamental investor. So basically, by having this cash position, you will be able to rebalance your portfolio, or deploy more on market falls, etc. So, and it will also sometimes help you hedge your portfolio when the market has really peaked. Just booking profits 20 to 30% and holding in some short duration passive funds or debt funds, etc. This cash component will both hedge and also come in handy when you have to deploy again. So these are just 5 simple steps for you to follow to building a good stock portfolio. I have given the link to an article we have written in detail by Aarti Krishnan. You should go through it to understand how you can go about. There are other tips also in that article, and do read it. And I hope you benefit. Please subscribe to our channel so that you get more inputs. Thank you.